Welcome back everybody to the channel where we invest in our personal and financial growth. Now today I want to teach you something that was really hard for me to find out, so I hope you find it useful. I neglected this instrument for years. I asked around in my environment, friends that were investing at the time, and also colleagues. So I asked other teachers, hey, do you know this instrument? Apparently they don't even invest, so that's a sad story, but that's off topic. I also didn't investigate enough because I heard stuff like, oh, it's super risky, 80% of the people lose money, risk. So basically I was turned off by that because I don't want risk, and I stopped investigating, and that was my mistake. So through this video I want to teach you how you could use options without the risk, but as a long-term investor to let's say get a discount on the market. Let's say you want to buy Disney, you want to buy 100 shares of Disney, but not at the market price right now, you want a 50% discount. Well, you could do that, and I will teach you how. By all means, this is not investing advice. I just want to share a little bit of my knowledge and hope you find some use for it. And knowledge is power, right? So you don't have to use it. I just want to share some knowledge because I would have found it helpful when I was like 2 years earlier or 3 years and didn't know about this. Let's go and get into the details. So if you buy a stock, it's basically a contract that gives you part ownership of a company in exchange for a price. But options are more about a transfer of risk. It's an agreement to buy or sell at a later moment in time at a specific price. Now there are two kinds of options, call and a put. And you have two kinds of participants, buyers and sellers. That leaves us with 4 outcomes. Now this may seem complicated at first, but it helped me to look at it like this. Sellers, whether it's calls or puts, are like insurance companies. They offer an insurance and thus have an obligation to buy or to sell. Buyers of calls and puts are like customers wanting some safety or bettors wanting to bet that the price will go up in a specific time frame. Now ask yourself this, who makes more money on average? The insurance company or the customers of those products? That's right, so we want to be the insurance company, right? And increase our gains that way. So let's dive in what calls and puts are, starting with calls. Basically a call is for upward moves in the stock. The buyer of a call thinks that the stock might go up big time and calls the insurance company to buy a call option contract that he may buy 100 shares at a certain price in the future because he thinks the price will be higher than that. So he gets to buy 100 shares at a discount in the future if that happens. Of course, there's no guarantee the price will go higher within that time frame, right? The seller of the call, the insurance company or casino, let's say, says, okay, I'll take the contract money, and if the price is higher than what you agreed upon, let's say it's 10% higher from here, I still made 10% on that stock because I own this stock anyway, 100 shares, plus my premium for the contract. So now let's talk about puts. Puts offer downward movements. So the buyer of a put is scared the stock might drop more than, let's say, 50% and wants some protection. So the seller, that's us, is the insurance company. Says, okay, fine, give me some money and we'll make a contract that if the stock drops below the set price, I'll buy 100 shares, even if the price at that time is lower. So this is us, because we already want to buy the specific stock, right? And if we bought 100 shares right now, we have no discount at all to the market price. If we agree to this guy, we could buy at a discount in case the stock drops. And if the stock doesn't drop, it's okay, because we still made money even if we didn't buy the stock at all because of the premium we get. So basically, we're just getting paid to agree to buy the stock at a discount from the market price right now. Crazy, right? So let's see how this looks at a real broker account. This is an account I made just for you guys to show in English because probably is a little bit harder to follow in Dutch. So let's first go to the options tab. Above here is the current stock price. Now to the left are the expiration dates. The longer it's in the future, the higher the price for the contracts, okay? Because the higher the uncertainty level. So we'll pick an expiration date for September, 2 months from here, right? Pretty short. On the left we see the buyers and sellers of call options. On the right we see the buyers and sellers of put options. So initially we want to sell a put option, right? So we're looking to the right of the screen. In the middle is the strike price, and this is the price on which we'll agree to be obligated to buy 100 shares through selling the put option, right? Now let's say we agree to write/sell this put option at $110. So we write the put option, we put in our limit price, which means the minimum will get paid, and we'll make the order for this day. After this day, it goes away if nobody takes it, right? And we're done. So how to choose your strike price? Well, we looked in this example, we looked at Disney. So let's look at Disney through investing.com. We could have some hints in what the price will do in the future by looking at what the price has been doing the last, let's say, 5 years. And you'll see it's not too far below the $110. Even if you put your premium discounted with that, it's even lower. So you've got a pretty good safety margin over there, right? And that's why you could look at past prices to reduce your risk even further with this strategy. So I made this spreadsheet for all of you so you could use it for free to calculate in which stock you want to sell a put or a call option, or on what time frame. You just have to fill in the numbers of the stock, the strike price, the premium, and you could calculate your returns. I included the Disney example for September, 2-month time frame, in which we would earn $331 if the stock stays flat. Bear in mind it's only 2 months. Longer time frames offer far higher premiums. But if you do 6 2-month time frames within a year, that would be better than a one option contract of a year. So your discount to the current market price in this example is around 9%, and you also get a premium of 3% within 2 months. Let's calculate what that looks like within a year if the stock price does absolutely nothing. It still returns around 17%. And if the stock price would drop, let's say 10%, normally we'd lose $1,200. Now we only lose $165 because of the premiums collected. In a scenario we actually also wrote call options, when we had to buy the stock, we'd still make a profit. You could also combine this with a dollar cost averaging strategy. Say you had to buy because of the stock dipped, you could also write another put option and buy at that moment. Maybe you want to buy at 4 different moments. You could write 4 different put options at different times and different prices of the stock. So just some strategies you could use by basically selling an insurance to people in the form of stock options. We made it within 10 minutes. I thought this would be a really long video, but I think I did an okay job at explaining. If I failed, let me know. I'm happy to explain it even better or try another approach. If I failed, let me know in the comments. Also, just for full disclosure, I don't use this strategy as my main investing strategy. Why? Because everything you do is amplified by 100. And most shares nowadays are really expensive, like the big tech. Google, for instance, is $1,500. So those are some really big numbers. If you amplify it by 100, it's not even payable for most investors. But even so, if it was, I still would be advising you to start small, because if you make mistakes, they're small, they're not a big part of your portfolio. And if you know and get more familiar with the product, you could increase your sizes and gain more. So my advice is start small, learn small, and win big. Okay, that's it for today's video. I would really love to know if it was helpful, maybe if you have some questions, or if you're using options now and plan on using them in the future, let me know. Anyway, have a really great day, and I'll see you hopefully next video. Bye.